I'd like to thank everybody for joining me today. Today, as we hit towards year end, it's always the time of season for tax planning. And, whether with tax planning, we're always looking for deductions, whether it's for ordinary income, capital gains, or if we're looking at tax credits. And a lot of times we can look at the tax credits after year end. But as we're approaching December 31st, one of the big tax planning tools is charitable giving. And as you start looking at charitable giving, the first thing I always like to remind everybody is what assets can you give to charity? I think a lot of people get caught up in the um, issue of I can only give cash to charity. And if you look at it and open your checkbook and write a check, you may not be taking advantage of everything that you want to give. It's, if you start looking at, just your investment accounts, you can give appreciated assets to the charity that if you give the assets that are appreciated to charity, you don't have to recognize the actual built-in tax gain inside of those trading accounts. So let's assume you have Google stock that has $100,000 of extra gain in it. Well, if you were to give that to charity, well, you get the deduction for the full fair market value of that stock. You didn't ever have to recognize that $100,000 of gain. Now, I'll tell some people that and they'll come back and say, yeah, but I want to own Google stock. Okay, give the Google stock to charity with the built-in gain inside of it. Now you don't have to recognize that, but you're going to get a charitable deduction. And then take your checkbook and go buy Google stock to replace that. So you can start doing some planning even within your charitable giving. Now, when I start looking at, charitable giving, it's not only what assets we can give to charity, but also how we give it to charity. So the easiest one is a direct gift. So a lot of times I'll see direct gifts that you want to give money to your church, or you want to give money to, a club that you're involved in. Well, if you're going to give money to your church, typically the easiest thing and probably the most often done is just a direct gift. You're going to transfer, either write them a check and give them cash, or like we just talked about, give them the stock so that you don't have to recognize that gain. But you're going to give that direct gift, and if you do it before December 31st, you get a tax deduction for it. So direct gifts are always the easiest one. Now, another one that I want to talk about because it's that time of year, do you want to give some of your retirement account, especially if you're going to have to take required minimum distributions, and these are assets that you don't need. This is income that you don't need. Well, you can do a qualified charitable distribution. Now, if you make that distribution, you can distribute from your IRA. Now, you don't get a charitable deduction for this, but you can exclude that from your taxes. So there again, it will bring down your adjusted gross income and help, maybe, reduce your Medicare tax. It'll reduce the tax on your retirement accounts. So there's ways that can be a benefit. Now, to do a qualified charitable distribution, has to be an IRA. You have to be at least 70 and a half to make this work for you. And the maximum that you can give is 105,000 per year. But the big key is it counts towards your required minimum distribution. So there again, if you don't need the income and you're going to have to make a required minimum distribution, think about, if you don't need it, can you give that to charity? Qualifies counting towards your required minimum distribution. And there again, it's not going to be includable in your income and therefore not taxed on it. A lot of times as I talk to clients, it's like, well, I want to give to charity, but I'm not quite in the position where I have enough income to live on. So I think of this as charitable giving plus. The plus is, can we take something back? So a charitable remainder trust allows you to make a charitable donation. So to do this, we have to set up a charitable trust. Now, this charitable remainder trust is going to be designed for you. And once we get this designed for you, you're going to transfer property into this trust. Think appreciated stock, appreciated real estate, assets that to you they're not a legacy asset. It's not an asset that you plan on moving to your kids, but it's an asset that you want to now turn into income. It's a rental property that you're done fixing toilets. You want to enjoy your retirement years, therefore you're going to sell it. But a lot of times people don't want to sell it because of the tax. If I sell that rental property, I have a huge tax gain. I don't want the tax gain, therefore you continue to keep fixing toilets. In this case, we can set up the charitable remainder trust. We transfer that property in. We have to make sure that we transfer it in before any sales documents are signed, and the property can't have debt on it. But once we transfer that into the charitable remainder trust, the trust can now sell that property income tax free and reinvest those funds inside of the charitable remainder trust. Now, we've now exchanged rental property for portfolio assets that are going to generate an income. When we do that, we trigger that charitable deduction. You get the charitable deduction. If you can't use it all up this year, you've got 5 rollover years to use it up. Once we do, now we can create an income stream to you. Part of setting up the trust is deciding what that stream of income is going to be. 5%, 6% of the principal, whatever it is, we'll help you figure that out. Now, after you die, or if it's for joint lives, after both you and your wife or spouse die, whatever is left goes to charity. So the charity can get a lot, they can get nothing, but at that time, you've used all of the income potential, and now it's going to go off to charity. But you get the charitable deduction today, you get the stream of income over your life or joint lives, and the charity gets whatever's left. Now, we can also do the reverse with the charitable lead trust. With the charitable lead trust, we can move property into the trust. We don't sell the property tax-free inside the trust, so sometimes we'll use cash, move that in, get a charitable deduction. But here's the reverse. The annuity stream, a set percentage of that annuity stream is going to go to the charity each year. So the charity gets 5%, 6%, whatever that is, over a 5, 10, 15-year period. At the end of that term, whatever's left in the trust now comes back to you, and you can use that for your retirement income, pass on to your kids, whatever you want to use those assets for. There again, great way to create a charitable deduction now. You get to benefit the charities today, so you get to see the good that your money can do. And then at the end of that term, it's going to come back to you to distribute either for your retirement, for your family, however it fits into your estate planning picture. Now, finally, I look at it, can we leverage our assets? A lot of times when I look at leveraging assets, think about assets that are underperforming or assets that you don't need. Let's say you have a $500,000 CD or money market account or whatever. You don't need it. It's there for what if, but you're going to pass that on to your kids. We look at it, can we reposition that into life insurance? And there's a reason that we're going to look at repositioning that into life insurance. First of all, it's to take care of you. What if the reason you were keeping that asset as a CD or money market account, what if you need the money? Well, we can pull that cash value out as either a withdrawal or a loan. You can use that money for whatever you want to use it, make gifts to the kids, go on trips, use it for your long-term care needs, use it for business. There again, whatever you need, however you need it, whenever you need it. And if you don't need it, it's just going to carry on as death benefit onto your heirs. But here's where we look at leveraging. We can give that money to the heirs, but we can also carve off part of that to go to charity. So upon your passing, the kids get what they need, the charity gets a benefit at your death, but we've leveraged that death benefit instead of, a $500,000 asset. Maybe it's $1 million asset now. So $500,000 can go to your kids, that's what they were going to get anyway. $500,000 can go to your favorite charity to benefit them upon your passing. All of that can be done in a tax-free environment if we do it right. The bottom line is, this is the time of year. Look at your charitable giving. Look at your tax picture. If you can give more, do it. And if it fits in, great. So think about that, and we'll talk again next week, and appreciate your time.